Thank you. So good morning, everybody. So I'm going to take on a slightly lighter subject, and I want to talk to you about new direction in index investing. I'll do this with a particular focus on ETF because this is what we do. And I'm going to start by taking you back a few years in 1989 because something very important happened then. Let me show you some pictures. So this is the first breach of the Berlin Wall. This is the mission Galileo, which was sent to Jupiter to explore the atmosphere of the planet. And this is the first Game Boy released by Nintendo. Something much less exciting but very important happened that year as well. And this was the listing on the Philadelphia and American Stock Exchange of a vehicle which was called Index Participation Shares. And this was, in a sense, a listed tradable tracker for the S&P index. So basically an ancestor of today's ETF. Now, that experiment didn't really work out because of a legal dispute, a big surprise. However, it was repeated a few months later, and this time successfully in Toronto, Canada. So the ETF industry was born. Now, let me show you where the ETF industry is today. So this chart displays the asset under management in ETF globally. So on the y-axis, you have the AUM in US dollar billion, and on the x-axis, you have the year from 93 until March 2016. So in green are the assets in equity ETF, in blue fixed income ETF, and in yellow mainly commodity type of product. So the first message is around impressive growth in terms of asset. And the second message is around the color of these bars, because you see until 2002, 2003, it's all green, so all equity exposures. It started with market beta, and then it became more granular in terms of sectors and geographies. In 2002, a major innovation took place when Barclays launched the first bond ETF ever. And since then, the share of fixed income ETF became bigger and bigger, and today you see it's a considerable chunk of the global investment universe. So the trend, same story for commodities. At some point you have the introduction of the trackers for the standard commodity index, and then you find the vehicles that give you exposure to single commodities. So the trend is quite clear. It starts with exposure to market beta that becomes more granular in terms of region and sectors. Then you have fixed income beta, which then breaks down into different segments and regions, and eventually commodity, overall market, and then a single commodity product. So the question is, what's next? What are the new developments in this area? So we think that there are a few major areas of development, a few important trends which are going to reshape, or at least they have the potential to reshape the industry in the coming years. And let me show you what they are. So this, the first one is smart beta investing, which is by far the most important. So essentially, rule-driven strategy that capture exposure to certain factors in one particular asset class or across asset classes. So like value, momentum, carry, and so on and so forth. Second trend is around sustainable investing, ESG, impact investing, you can call it the way you like. And finally, thematic investing. So this is mostly about getting exposure to particular themes which are not captured by the traditional sectors, geek sectors. So I'm going to briefly talk about each one of these three topics, giving some examples. And I'm going to start with the smart beta investing. In particular, I want to focus on the fixed income side of it because it's a little bit less explored. First of all, a picture about the flows. So here you see the asset under management in ETF globally for smart beta product. On the y-axis, you have the AUM, and on the x-axis, you have the year from 2011 until the end of last year. So the color refers to the type of smart beta product. So dark green, it's for a dividend type of product. and then it's followed by multi-factor, equally weighted, mean vol, and single factor type of product. So again, massive growth over the last few years, but there is one important point here, and it is that all these exposures are equity exposures. So what about fixed income? Now, fixed income is actually in the chart, and it's the very tiny silver line on the top, which you can't even see probably, but it corresponds to around 1 billion of assets as of today. So why it is that? Like why so little allocation, so such a small allocation in fixed income? So we tried to give an answer to this question, or at least we thought about it. And let me show you a very simple exercise we ran. So this chart shows the cross-sectional dispersion of returns for a universe of investment-grade bonds. So at each point in time, since the 90s until 2015, we look at the constituents of the Barclays US corporate index, investment grade, and we calculated every month the cross-sectional dispersion of returns, where we were bucketing the bonds by sectors. So this is the behavior of the dispersion, which is measured by the standard deviation. So, like a big number, it means that all the returns they tend to be spread out. Otherwise, if the number is small, it means that they cluster together. It's a measure which is interesting because if the dispersion is high, it means that you have more potential to generate outperformance by picking the right bond or selecting the right sectors. If the dispersion is very low, you're not going to generate much outperformance because everything moves together. Now, the interesting part of this chart is when you compare it with the same exercise done for equities. So for equities, similar universe, so US equities, large, middle, small, same time period, but obviously the dispersion is much higher. It's not a big surprise, and admittedly, if I had run the exercise for high yield instead of investment grade, the gap would have been smaller, but still, it's quite noticeable. And this basically tells us that in fixed income, it is much more difficult to generate the type of outperformance by simply reweighting a standard benchmark, unless you want to use leverage or unless you want to go long short. And again, it doesn't mean that there is no potential for smart beta in fixed income. It just means that you need to set your expectations at the right level. You're not going to see the level of outperformance that you can observe in equities, unless you leverage or go long short. But we don't want to do any of these things in an ETF wrapper. So what you can do instead is looking at the benchmarks, at the standard fixed income benchmarks, which are all market cap weighted, and acknowledging that they have a few inefficiencies, and maybe using the smart beta thinking, like factor thinking, you can address these inefficiencies and correct them. I'm just going through what these problems are, but I think they're very well known. The first one is the lack of geographical diversification. This is the regional breakdown for a global sovereign index, and you see that most of the weights are concentrated in a couple of countries, United States and Japan, which is not exactly ideal for an index which is supposed to represent global sovereign debt. On top of that, usually a very high weight corresponds to a lot of issuances, and this is not necessarily indication of very solid fiscal position. However, this risk is not necessarily rewarded by a higher yield, and you see that in this chart where I'm showing the weight in yellow and the yield in blue for all the countries in the global sovereign index, and you see things like Japan, where the yield is very, very low and the weight in the index is massive. So obviously reweighting or tilting the weights in the global sovereign index toward those countries where the risk is properly rewarded should allow you to get a more balanced and better risk profile. Final consideration is around the lack of risk diversification. Here it's this is like a risk report that we have run for the Barclays US aggregate index, which is supposed to represent the sovereign and investment grade corporate debt for the US. And you see that pretty much all the risk, it's interest rates risk. So there is no contribution that comes from credit. Again, I mean, if I'm buying the Barclays AG, I'm expecting exposure to both factors, not just one. Otherwise, I'm going to buy sovereign treasuries. So again, you can design methodology where basically you try to rebalance the contribution of these two different elements and get a more balanced risk allocation. There are a lot of products out there that are doing this type of things. It's important to look at the problem from the right angle, because if you're expecting to see like an historical simulation that outperforms like the standard benchmark after 20 years of bull market in bond, that's not going to be possible. So it's all about what you think is going to happen in the coming years and the type of position and risk exposure you want to get. So I'll leave it there for fixed income, and I'll move to sustainable investing. Now here it's this is a very vast topic, much less popular than smart beta, but still quite interesting. Let me show you just a very quick flow breakdown for the European market. The European market, just because this topic in the US is not really flying. And I'm focusing on the ETF market just because it's easy to look at the flows. The bar shows you the percentage increase from one year to the next in asset under management. And the color of the bar represents the different sectors of the sustainable ETF category. So you have ESG, which stands for environmental, social, and governance. So basically here you're just trying to reweight the benchmark in order to achieve a higher score from an ESG perspective. Usually these scores are numerical ones, but they map into like a standard framework like A, single A, double A, triple A, as for bonds. And then you have exclusionary. Those are like standard benchmark where you remove controversial stocks, like controversial weapons or tobacco or things like that. Impact, I'm not even talking about it because it's too small. But you can see on top of each bar there is a number. Those are the asset under management, around 3 billion as of today in dollars, so not very much. But they are growing quite fast, especially over the last few months following the Paris conference. So it's a topic that it's worth keep looking at. The point I want to make here is around the way these products are constructed, because these are all mainly equity products, a few fixed income ones, which are built by taking the standard benchmark and reweighting the benchmark in order to increase the ESG score. But that's not there is no reason because you should add the ESG overlay just to a standard benchmark. You can take a different exposure, like a smart beta product, like a momentum index or a value index, and try to improve the ESG score and make it more ESG friendly if you want. So we just wanted to see if that was possible without altering too much the risk-return profile of the strategy. And we can do it in different ways. Like if you go through each one of them, you see most of them mathematically are actually equivalent, provided you pick the right level for the parameters. But so let's say we take a momentum strategy. You can make it ESG friendly by just redesigning it. So you remove from the universe everything which has a bad ESG score, and then you apply an optimization that maximizes the momentum exposure. Otherwise, you optimize for momentum with an ESG constraint. So you say, I want my rating to be at least, I don't know, triple B. Other methodology, you combine momentum score, ESG score in one unique metric, and you optimize for that. Finally, you can just construct a momentum index, and then on top of that, you apply an optimization which is supposed to maximize the ESG score while maintaining the tracking versus the parent momentum product very tight, or at least within a reasonable range. So we did this exercise. Those are not like necessarily tradable indices. The turnover is very high, the rebalancing is very frequent, so don't get fooled by the very nice chart. But the idea, I think it's interesting. So what we did, we took a universe of global equities developed. We constructed the benchmark, which is market cap weighted, which is the green line. The cumulative performance is the dark green line. And you see it has a triple B rating. by default. Then on top of that, we build a momentum strategy running an optimization. Every 3 months, you reweight the stocks, maximizing the exposure to the momentum factor, and you get the blue line, which is a BBB rating still. And then we took that we decided to make that product more ESG friendly. So we ran the same optimization, but blending ESG and momentum score in one unique metric, and if with a few sectorial constraints. And if you do that, you see you get the yellow line, which tracks the standard momentum approach not very badly, and has a much better ESG score. It's a AA instead of a BBB, so basically you improve it of 2 notches. It's quite easy to do. You can run it across many different universes, as long as you have enough stocks and you are working on in developed market. It's not too difficult to improve the ESG by keeping the tracking very low. Final thing, I'm not going to touch that. So final thing is about thematic investing. Just a few words on that, just because it's sort of a cute topic. So the idea here is that there are no assets at the moment, at least in Europe, in this particular industry, but it seems to be a growing trend. We see more and more interest, so that's why we started to do some research on that. In fact, we did it with STOXX. And the idea is that there are a few big macro trends which are going to shape the society in the coming years, like the aging of populations in developed countries, the power of technology, and so on and so forth. So you want to get exposure to those particular themes which are going to benefit from these big trends. And obviously, you can identify these themes in different ways. You can have like the self-driving cars, wearable technology, I don't know, video games, cybersecurity. You have plenty of things out there. But from our perspective, meaning ETF industry, you want something which is very big, which is sufficiently liquid, and is going to stay viable over a long run. Otherwise, it's not going to be implementable in an ETF wrapper. So a few themes we came up with and on which we did some research are here. So you have aging population, innovation in healthcare, automation and robotics, and digitalization. So nothing really surprising. The only point I want to make is when you build an index or a strategy that tries to get you exposure to these themes, it doesn't matter how you do it, but it doesn't really make much sense to backtest it, because some of the topics or some of the themes covered by this classification weren't even relevant a few years ago. So whatever you find in your backtest, it's sort of misleading. You need to do these things in a forward-thinking way. Of course, we did a backtest, and this is the result. It's just for fun and to show some pretty charts, but it's still interesting. So the green line is the benchmark, is the stock TMI that we decided to use. Each line represents the cumulative performance of these strategies. They rebalance once a year, and they invest in all the stocks that provide exposure to the selected theme. So blue line is robotic, green line is the benchmark, the light blue digitalization, green, Asian population, and yellow is healthcare. The only point I want to make is around the blue line, which is not doing very well. This is the automation and robotic topic. It encompasses something in the region of 100 stocks. And one of the reasons of the underperformance is obviously the heavy exposure to Japan, hence the currency risk. But also the very highly volatile nature of the stocks that end up in that basket. Of course, you can make it look better on a backtest basis. You just weight based on inverse of volatility, or you remove the most volatile stocks. But that's it. Really, it's beyond the point, because what you're going to get here is exposure to the market, and if the market doesn't work, it doesn't work at the moment. I would close it here. I think I make my point.
Thank you very much, Marco.
Yep.